Hello and welcome to Making Sense of Financial Statements, presented on behalf of the Victorian Council of Social Services as part of the Clearinghouse Rural and Regional Training Program. My name is Michael McGann and I'm a Senior Project Manager for Matrix on Board, a consultancy company that works exclusively with non-profit organisations, building capacity in financial management, management support and governance. My background is in financial services, where I've spent the past 5 years working with small to medium-sized financial planning firms to help them achieve their goals and objectives. I hold a Diploma of Financial Services and a Master's in Organisation Dynamics, and at Matrix I work with CEOs and boards of not-for-profit organisations to help them to develop their management capacity through business and strategic planning. I'd like to welcome you to these training programs, which will introduce you to financial statements, some common accounting methods, and the importance of this information for boards when they make decisions regarding the current and future capability of your organisation. Accompanying this presentation is a participant manual, which can be downloaded from this site. If you have previously attended one of the workshops that were conducted, it is important to note that the presentation has been altered in structure to accommodate the short video format. However, the content is unchanged and can be found in your participant manual. In this, the second session, we'll look at the most common types of reports used and the differences between them. In particular, we'll look at the cash flow report and the balance sheet. Cash flow refers to the funds coming in and going out of your organisation. For example, grants received, interest earned, wages paid and utility bills. You might hear somebody talk about tight cash flow, which is when your expenses are equal to your income. Or you may have negative cash flow, which occurs when your expenses are more than your income. It is entirely possible for an organisation to have a surplus at the end of the year, but have negative cash flow months during the year. So that the board and the CEO can track the cash flow position of the organisation, a cash flow budget or cash flow report is often used. A cash flow report is a budget enhancement that allows the board to forecast how much cash the organisation needs to operate and when it will be needed. It might also help the board to identify when the organisation will not be in the black and to make arrangements for those times. Here is an example of a cash flow budget, and as you can see, it highlights the income and expenditure for 10 months of the financial year, 2009-2010. The balance sheet provides a snapshot of the organisation's financial position at the close of business on the last day of the reporting period. It lists all assets and liabilities. The balance sheet shows at a glance and at a specific point in time the balances of the asset and liability accounts and therefore the financial condition of the organisation at that point in time. The balance sheet, also known as a statement of financial position, indicates to the board whether the organisation has sufficient assets to cover its liabilities, and especially whether there is adequate liquid assets to pay any liabilities that may need to be redeemed immediately. It is in the balance sheet where the accruals are held. For example, when the organisation receives grants, the proportion of the grant not being applied to the current period can be found in a liability account called grants in advance or something similar. The balance sheet indicates the solvency of the organisation, that is, that it can meet its debts as and when they fall due. Ensuring solvency is the most critical responsibility of the board. Consequently, it must be accurate and up to date. The participant manual provides more information on the balance sheet. In the next session, we'll look at cash versus accrual accounting and the value of each methodology to your organisation.